Central banks basically have the power to print money at a whim, and they also have the power to hold a depositor's money to use for their own agenda. When you deposit your money into the bank, you don't actually own your money anymore.
Is legally, you have loaned that bank that money.
Yes. When you deposit money in a bank, the bank pretty much owns that money. You become what's known as a creditor or a lender to the bank. The bank just promises to give you back the same amount or any part of it whenever you ask for it. But what if I told you that if that bank fails, they can use your money and depositors' money to pay their debt back? It's called a bank bail-in, and it is designed to bail banks out from complete collapses during a crisis by putting the burden on the people who deposit into that bank.
But, there will be bail-ins when we least expect it.
Generally, your money is safe if the bank does not default and insured up to a certain amount. In my most recent video, I talked about how banks in the US only hold a small portion at hand of the cash that is deposited. It was 10% for a long time, and as of 2020, the amount required in reserve is 0, so that all the money deposited can legally be loaned out or invested.
But what I do know is they have barely more than 1 penny for every insured dollar.
So if banks aren't required to hold any depositors' money in cash, and they can make loans and investments that come with risk, why would anyone agree to letting the bank use their money to pay if their investments fail? Well, most people did not have a choice. So, you're a big bank and you are in charge of millions of people's deposits, like families, businesses, investors. But the problem is that you actually make a profit by loaning out or investing most or all of your depositors' money, which means you are insolvent. If all of your depositors came to claim their money at the same time, you definitely would not have the money to pay them back. You need to make sure that if there is ever a crisis so big in the economy that you have a way to protect yourself, because you are too big to fail. You need to be able to pay off your debts to stay in business. After the global crash in 2008, known as the Great Financial Crisis, the world realized that we were at the whim of the banks. The only way at the time to save the economy from completely deteriorating was for the government to inject billions of dollars of taxpayers' money to save the banks. Many of these taxpayers lost their jobs and had no say in the matter. Many people who caused the problem suffered very little repercussions. These institutions were making profit hand over fist by lending out loans that they knew had a high chance of defaulting or not being paid back, and then packaging them and selling mortgage-backed securities. But as the economy crashed, these loans weren't getting paid, and it created even more downturn in the markets. As Investopedia says on their website, this crisis showed us that banks are also subject to instability. So in 2009, US Congress whipped up a scheme to protect too big to fail banks from a failing economy and passed the Dodd-Frank Act. It was disguised as a bill to limit banks to not take on investments that are deemed too risky. On the flip side, it made it legal for banks to keep people's money to pay off their debts if the banks were to fail. According to Investopedia, the difference between a bailout and a bail-in is that during a bailout, the government injects large amounts of money to pay off the bank's debts. A big issue with that is the money originally came from taxpayers. A bank bail-in allows the bank to take the money that the depositors have and use that to pay off their debts, handing over the risk to the depositors. It is completely legal in G20 countries. After the Great Financial Crisis, governments pushed to pass this regulation as fast as they could in anticipation of heat in the economy. Why would governments push for a bill that allows banks to take depositors' money from their accounts? because maybe they're protecting the banks and passing on the risk to the depositors. Bail-ins have not been used in most countries where they are legal so far, but the country of Cyprus tested the bail-in system in 2013. Cyprus's largest bank, Bank of Cyprus, and second largest bank, Laiki, had a lot of investment in the Greek economy, which at the time collapsed and was bailed out twice after the global recession of 2008. Both banks were hit severely and shut down for a period of 2 weeks as the Cypriot finance minister reached an agreement with global financial regulators to bail them out. Laiki went bankrupt, forcing the Cypriot economy and real estate investments, which a majority were held in Laiki, into a downturn. Properties lost half of their values, and Laiki depositors lost most of their wealth overnight.
Not a bailout, but a bail-in, with bank customers bearing the burden.
Because Cyprus had a low rating on their treasuries, meaning that they have a high risk of defaulting, in other words, not being able to pay loans, the IMF or International Monetary Fund would not bail them out like they did Greece. The IMF is a major financial agency of the United Nations and basically oversees the central banks of the countries it governs. The only way out of this situation was to be bailed in by the customers of the major banks in Cyprus. It was termed the haircut, where most depositors lost a majority of their holdings to bail Cyprus out of the crisis. Laiki depositors were issued shares of the bank that were worthless since the bank was going under, as a promise to pay the depositors back in some time. Remember how I said that up to a certain amount of money it would be insured? In the case of Cyprus, the amount was $100,000, and anyone with more than $100,000 in their account, or what they call uninsured depositors, had almost 48% of their account completely written off. But even people who had accounts well under that limit lost access to their money. Businesses that had hundreds of people employed were no longer able to pay their employees since the accounts were on hold, which resulted in layoffs. It took many years for Cypriots to recover their money, and the effects are still felt now. Cyprus was a test of the bail-in system, and there is no guarantee that if it happens in any other country, people's deposits will be safe.
And they're going to see that the bank that they trust has dipped their hands in and taken out their cash.
As a bank, people rely on you to keep their money safe, and that's great, but that's boring business. It doesn't earn you a big enough return. The Dodd-Frank Act of 2010 is supposed to limit the bank's exposure to risky investments and loans, but even the least risky assets aren't void of risk completely. Some might argue that since the bill was passed, unburdening the banks of risk, these institutions have continued their spending and investment as if nothing has happened, which has been accelerated by a zero interest rate for 15 years. Because it's easier to hand out loans on low interest, which then get invested and the cycle continues. Nowadays, many banks, certainly in the US and Canada, banks place their holdings into less risky investments like government bonds and or commercial real estate. But the thing is that with major economic changes, there is no sector that is completely risk void. But if the government has an infinite amount of money, why don't they just print more and bail out the banks? It's a little more complicated than that. While that is a possibility, well, that would add inflation. Prices across the board on different necessities have risen dramatically because of all the extreme money printing we did in just 3 years. And if it's unbearable in the United States, imagine the effects around the globe. Other countries also depend on dollar for trade. And each time the dollar is inflated, it affects the economies that hold massive amounts of dollars in their reserves. But not having the Fed print you out of the situation leaves you with no money to keep the economy afloat. The institutions and governments had to get creative. You see, even the too big to fail banks are subject to changes in the economic system. Smaller banks or regional banks take loans from these major banks so that they can pay off their debts. They take on leverage, which means that they take on more loans and debt than they could ever pay back with investors' money. And what happens when these regional banks can't pay off their debts to the larger banks? As of 2024, most regional banks are considered insolvent.
So bank failures are going to happen this year for small banks.
Yep.
Many of them with holdings invested commercial real estate or U.S. treasuries. See, the commercial properties haven't been doing well since before the pandemic. AI taking jobs, companies downsizing workforce, and people working from home make the need for large office buildings unwarranted. Many commercial property loans are set to be renewed in the coming months. We're already seeing office buildings in San Francisco and other areas selling for a fraction of the original price. And guess what? Relatively nobody wants to buy them.
That's because A, the cost of borrowing is up, and B, the value of those buildings are down.
As of now, U.S. treasuries are deemed safe to invest in. So that leaves us with the question, if there is no money in the economy to bail banks out, and many banks could be facing hardship, where will the money to get us out of a terrible recession come from? While it is not certain that any of these things will happen, one thing is guaranteed: banks have the power to use their depositors' money to dig themselves out of the hole if it comes to that. If this is causing you panic and stress, relax. The last thing we want to do is panic, because if depositors begin to panic, it can cause a bank run where they pull their money out at the same time, causing the system to break. Being prepared ahead of these situations is more effective. That's why I am looking into diversifying my wealth into other assets, such as gold and silver, which have proven to hold their value against a weak economy and inflation of the dollar over time. Buying land and resources that can lead to sustainable living is a good idea, and working with others in a community to build strong ties. Owning some crypto like Bitcoin and major cryptocurrencies could be useful for moving your wealth securely. While none of this is financial advice, knowing how money runs the world can help people avoid the disparity of economic crisis, in my opinion.